Hello and welcome to Market Domination. I'm Jared Blickley in for Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are falling on the back of that February jobs report. Joining me now on the latest market action is Marta Norton, Empower Chief Investment Strategist. And Marta, I'm so glad you're here with us. I want to start out with a couple charts on the Wi-Fi Interactive. If you can't see them, I'm just going to call them out here. S&P 500 down about 1.7% this week, but it looks like it wants to close under a key level here, 6,800. Haven't seen that all of this year. And then you go down to crude oil, and my goodness, this is the biggest jump in WTI we've seen since the beginning of futures in the US in 1983. I checked that, and we are up 12% today. The high was nearly $93. What are you making of all this?
I mean, clearly we're in a period where geopolitical risk seems to be building, not abating. I think there's some realization on the part of markets, on the part of investors, that this particular conflict is not necessarily something that's an overnight affair, that this is something that's going to linger. We certainly saw that with President Trump's comments on an unconditional surrender. So I think there is some adjustment to this idea that higher oil prices could be with us for a while. Uncertainty could be with us for a while, and markets are bracing for that.
And that's the vibe that I've been getting from a lot of strategists, portfolio managers that I've been talking about through the week. Nevertheless, you take a look at the VIX Volatility Index, we haven't seen true panic levels. We didn't even see 30 on it yet. So how does a prolonged conflagration get priced into the market? What does that look like in stocks?
Well, I think the primary throughput is really energy prices. Now, we know, based on what we understand about the fundamentals of the U.S. economy and what we understand about what we've seen in geopolitical turmoil in the past, that U.S. stocks aren't necessarily overly concerned about what happens overseas, simply because it doesn't ultimately impact a lot of their drivers of cash flows, but certainly it does impact energy prices. And so I think that's where we really are going to watch to see how this conflict shakes out for markets. Of course, that has economic implications. We can talk about what that means for inflation, what that means for the pace of rate cuts. But I think all eyes point to the energy market as this continues to move forward, and less so on the stock market.
And let's talk about that calculus at the Fed. We haven't even mentioned the payrolls report from this morning, which printed a negative number. It was the second worst headline payrolls number since the pandemic. And so that makes me think maybe the Fed wants to get in rate cutting mode. But then again, you have these higher energy prices. And so there is that inflation pass through. What do you think the Fed does here?
Right. So certainly rock in a hard place. I think there's a few thoughts that are probably ruminating at the Fed. The first is, how much do higher energy prices actually impact inflation? And of course, that depends on how high energy prices go, how long they last at those higher levels. But I think generally speaking, research suggests that while there is an impact on headline levels and there is an impact on core levels, it's maybe not as severe as people might think. Meanwhile, we know the Fed very much cares about labor market deterioration, and that has been an emphasis in the minutes that we've seen over the past several months over the course of this cutting cycle. So my guess is, if we were to get a string of surprisingly weak labor market data at the same time this conflict lingers on, my guess is that the Fed will still lean toward the labor markets and we'd still get some cuts.
I want to switch over to markets here, kind of focus on some of the sectors and industries. It's been red this week, but there's one industry that stands out to me, and that's software. If we can go to the Wi-Fi Interactive, I will show you the 5-day price action. Palantir, that's AI adjacent, that's up 17%. A lot of these names have been absolutely obliterated over the last 6 months, peaking in November, October, September, but we saw them come back this week. So what I noticed was kind of a rotation trade. What was doing well this year did not do that well this particular week, and the opposite. What has not done recently has done a little bit better this week. I'm wondering what you think of the software trade, if software is finally back, or if this is just some short covering or what have you.
Well, it does seem there's been this massive shift in narrative, right? So February was all about AI disruption, all about, hammering on areas like software. The narrative suddenly shifts as we move into March, and now it becomes all about geopolitical risk. So maybe some of that AI disruption fear has just faded into the background. When I think your word obliterated is the right one. When I take a look at the software
almost said
space,
decimated, sorry.
Oh, decimated.
No, I almost said that, right. But I decided on obliterated.
Well, if we're thinking decimated, I mean, it really has been a punishing period. Potentially rightly so when we think about some of the margin squeeze that's coming. But I can't help as a price-sensitive investor to start looking at some of this area and wonder if it's overdone and begin to think, can we sort through some winners, some survivors, and maybe find some opportunity there?
Want to ask you about the dollar and gold. First of all, U.S. dollar index shot up Monday, Tuesday, and if we look at the Wi-Fi Interactive one more time, you can see what's happened this week. We've just been trying to poke through basically that 99 level, and 100 is kind of a big one. If I go back 6 months, you can see we've just been in a range here. We got 100 and change at the top and maybe 96 at the bottom. And then you take a look at gold, which really, we saw a little bit of a surge Monday, but it has been going kind of sideways to down ever since then.
Yeah.
So what do you think about these two trades?
Well, it's interesting. I mean, I think there's a lot of cross currents that we're really kind of grappling with here. Of course, with the dollar, that is a flight to safety trade, as is gold. But I think one of the considerations there is just the thoughts around what energy prices could mean for inflation, the dollar effect given that oil is traded in U.S. dollars. And then when we take a look at gold, I mean, this is an area that has seen a just one-way highway with moving higher and higher. And so there is some momentum effect there that could be unwound, particularly if people worry about some of these, you know, the potential for maybe rates not going quite as low as they had thought. So I think we're just kind of grappling with a wide range of scenarios as we're looking at how these different asset classes are behaving.
Yes, it's important to keep in mind that gold is way overextended to the upside still. And
That's
if
right.
Liquidity is getting reined in, well, it could take a hit. Last question here. I'm going to give you the floor. Anything we didn't cover that you'd like to say to investors?
Well, you know, I think at this point in the game, it's really easy to let these headlines just overwhelm us, whether it's AI disruption or it's geopolitics. But I think a really important characteristic for long-term investors is really pushing against the grain. And so that's why areas like software, even elements of the Mag 7, are more attractively priced in my mind and actually create some opportunities. So yes, scary headlines, but opportunities are still there.
Yes, and it's important to note too that the Mag 7 hadn't done that well this year, but nevertheless doing okay this week. So thank you so much for stopping by, Marta. Learned a lot here.
Thank you.
And joining now for more on the economic lens on the impact of geopolitical tensions and labor market turbulence, let's welcome in Interactive Brokers senior economist Jose Torres. Jose, great to have you here. Let's focus on the payrolls report because we saw that negative 92,000 jobs in February. So 92,000 jobs lost versus 126,000 in January. And what I noted with Martha just before you was that this is the second worst headline number since the pandemic, going back about 6 years. Unemployment rate, 4.4%. What are you making of the whole thing?
Jared, great to see you. I'm a little worried because if employers didn't hire much in February, then what are they going to do in March, considering the global uncertainty that's going on? Part of the weakness was the labor force participation rate, Jared, dropped to a 50-month low. Wage pressures were a positive. Unemployment rate ticked higher. But overall, it does look like the Fed is going to dish out several rate cuts, even if oil prices remain elevated. We saw yields reverse several times today. Fixed income investors weren't sure if they wanted to prioritize higher inflation expectations or a slowdown in labor conditions. But all in all, really bad report. Part of the headwinds, Jared, are the lack of immigration. You have AI adoption, and then you also have the rate-sensitive sectors, construction, manufacturing, and small business, that don't feel comfortable expanding unless we get a few rate cuts.
Yes, noting that IT lost 11,000 jobs. One of the big ones was healthcare lost 28,000 jobs. This has been one of the biggest sources of expansion in the jobs market over the last few years. So healthcare and education, but part of this was driven by some strike activity in physicians' offices. They lost 37,000. Talk to us about some of the industries in the report.
Absolutely. So the healthcare strike took off 31,000 from the headline number. So you still lost roughly 60,000 or so. And then when you look at leisure and hospitality, that was a negative. That that's a big discretionary sector. So that was a little bit of a concern there. We also saw losses in manufacturing. Manufacturing employment is down to the lowest level going back to 2022. That's another negative. And one thing, turning to markets here, Jared, this week, I was listening to your previous conversation. This week, we haven't had a day where the S&P closed near its low. We always have this ferocious rebound. And part of that, Jared, is that the markets has gone sideways for 4 or 5 months now.
Yes.
The economy's continued growing. Profits have expanded. Valuations here, Jared, are starting to look good, and folks are looking for some of those areas in the market where they can come in and maybe get some bargains. And then the rotation trade that really drove rallies in the Dow and the Russell 2000 in January and February, that's being unwound because now you're worried about economic growth and you don't have as much rate cut optimism. And that's really what those benchmarks need. So folks are rotating back into the tech and the software sector.
Yeah, Mag 7, Russell 2000, to your point, down about almost 4% this week. But I want to talk to you about energy. As I noted with Martha, $93 per barrel WTI, biggest gain ever for the WTI contract going back to 1983. What do you make of this, and what are the implications for the economy?
Jared, big problem. January CPI was 2.4. February is likely going to be 2.4. Right now, here at Interactive Brokers, we calculate every single day what we think inflation is going to be. And if oil prices, based on the average from March 1st to now, we're looking at a CPI in March that'll be released in April at around 2.8% or 2.9%. So that is a big problem, and really a bad setup for Fed Chair nominee Kevin Warsh heading into the Fed, with President Trump, of course, wanting imminent monetary policy accommodation. He may be able to dish out those rate cuts, Jared, but what's going to happen to the long end, especially against the backdrop of someone that has been an opponent of balance sheet expansion for so long? We know other developed nations around the world, they go out to the long end, they buy that debt to really quell interest rates at the duration, particularly Japan. So those are some risks moving forward. And, we'll see what happens. But if oil doesn't come down soon, then we will have an inflation problem here in the first half of 2026.
All right. I'm really glad you mentioned bonds. And I just want to break this down and keep it simple. When you're talking about the long end, you're talking rates, basically U.S. debt, 10 years, 30 years out. And one of the biggest concerns of the second Trump administration going back to February, January, even January last year, has been those bond market yields. When the long end is surging and it gets like the 30-year above 5%, you see stocks roll over. And arguably, President Trump has been more focused on the bond market this term than the S&P 500, than the Dow, than stocks. And so I'm wondering, and tying back to your original comment, Treasuries are trying to figure out what to do this week. They have not caught that flight to safety bid like they have in the past. So how do you see this all working out in the bond market?
Yeah, President Trump has that real estate background, tends to be a Treasury bull, wants lower interest rates. I think ultimately, with inflation heading to 3%, unless oil starts to fall soon, you're not going to have much relief at the long end, and it's going to be problematic for the Republican Party in the midterms. Already from January 1st to now, they've been losing ground. It was thought that it was almost guaranteed, Jared, that they would maintain their majority in the Senate. Now that's down to around 59%. The House is essentially going to be controlled by the Democrats based on current odds. So I think that in the midterms, the GOP is going to pay for the Iran war, as well as, tariff cost pressures, which have been really modest, haven't been very material. But combined with the Iran war, of course, that's a different story. The Fed, of course, doesn't look at energy costs, Jared, but to move around goods and to move around services, which are in the core PC and the core CPIs, you obviously need crude oil. So things like airline fares, of course, that's a service, but heavily tied to the commodities price.
Yes, and to your point, transportation stocks and also airline stocks, travel stocks, really taking a big hit this week. We got under a minute here. I'll let you just final words for the viewers. Anything we didn't cover here?
Yes, Jared, I want to talk about Russia's invasion of Ukraine because we had a similar spike in oil, not as fast as you said earlier.
Yes.
But the Fed, Jared, would not have raised 525 basis points if it weren't for that event. It might have only risen 350 basis points, 375. So that's a major risk going forward, that you're going to have these tighter financial conditions unless we have peace in the Middle East pretty soon.
Yep, very good. I'm glad we ended there, and wish you well here. Thanks for stopping by.
Thank you, Jared.
And coming up, we dive into the latest legal battles surrounding President Trump's tariff policy. That is up on market domination. Companies searching for tariff refunds have taken big steps forward this week. A federal court has ruled that the Trump administration must refund all duties collected from illegal tariffs. Ben Werschel has been following the latest developments. So Ben, how is the administration reacting to this first?
Yeah, so the administration is definitely reacting to this order. This order came from the Manhattan-based trade court that took a single case about a single company asking for a refund and really sort of took people by surprise this week by broadening it out and saying all companies that were affected by these so-called IEEPA tariffs need to be offered refunds. The Trump administration's initial reaction here is to sort of signal that they're going to at the very least drag their feet on this. A new filing just today from the Customs and Border Patrol basically argued that technically the Border Patrol can't offer these refunds immediately because of kind of computer and technical issues, although they say they're going to put forward all efforts to put a system in place in 45 days. That's the time frame they're putting there. This is going to be a lot of back and forth, but does come, as you mentioned, the top after a week that began with the Trump administration trying to sort of put the refund issue on ice for a whole 90 days, and a sort of series of rulings from a couple different courts have really kind of put tariff refund advocates on the offensive here as they're trying to push the administration act. Signs are from the administration, again, they're going to draw this out for as long as they can, and we're widely expecting an appealing of this ruling from the Court of International Trade in Manhattan. But clearly a shift here, even if there's no real clarity yet for businesses on how they're going to get tariffs or when they're going to get tariff refunds. That's still a lot to play out, but it's clearly kind of moving, at least for this week, in one direction.
All right, we'll come back to that appeal if we have time. But first, I understand there's another lawsuit, and this is coming from 24 states. And you're writing about this for Yahoo Finance. What's the deal there?
Yeah, so this is another tariff tariff issue. This is current tariffs. This is a lawsuit from 24 states, all Democratic governors and attorney generals challenging current duties. This is how basically at issue is how Trump responded when the Supreme Court struck down his IEEPA tariffs a couple weeks back. He replaced them with a different tariff authority called Section 122, 10% tariffs immediately. He has promised to up that to 15%. This lawsuit says that Trump's logic in putting forth these tariffs is quote, fatally flawed, because this is based on a 1970s law that they call archaic to the current trade situation. There's a lot of legalese here, but it's a balance of payments is the issue under control here. The legal analysts I've read about this don't offer that there's kind of a slam dunk case for either side. It's not clear that this would be struck down or this wouldn't be struck down. The administration is promising to vigorously push back on this. The skepticism about how the long-term effects here is essentially the timing issue. These are tariffs. Section 122 only allows tariffs for 150 days. That means they will go away this summer one way or another, and the Trump administration has already signaled how they're going to replace them in roundabout in July when those go forward. The question is, can these Democratic states offer any sort of change in the immediate term? There's a skepticism there, short of a judge basically putting a pause on these tariffs. But this will be an issue that the court case will play out for potentially months or years, even with these tariffs going away in late July.
Yeah, so we've seen these legal battles stretch out for months, if not years sometimes. So let's get back to that appeals in the original topic we were talking about here. How is that expected to play out?
Yeah, so the trade attorneys that are in the middle of this issue on this tariff refund issue, again, the way the appeal process they're expected is that it's a bounce back to a higher court called the U.S. Court of Appeals for the Federal Circuit. This court already took sort of significant action this week to say that the Trump administration can't hold off on tariffs for 90 days. They sent it to this Court of Trade. Now the Court of Trade has offered this broad order that all tariffs need to be refunded. And now the question is expected to be, does the Court of Trade have that authority to offer such a broad mandate? Basically say you have to pay back all these tariffs, which the government estimates to be about $166 billion. There's a question here about whether once it gets back to this federal circuit, it will uphold such a broad mandate, but it's clearly going to bounce back and forth there. But this trade court is clearly aiming to get these done as quickly as they can, either in a broad way or with this one judge, his name's Richard Eaton, sort of processing these cases as fast as he can as they go back and forth for weeks and months ahead, potentially.
Yes, Ben, we got to leave it there, but always great talking to you, and thanks for laying all that out. Great job. And AI quickly becoming a battle fought on multiple fronts. The Pentagon has formally labeled AI leader Anthropic a supply chain risk, giving what CEO Dario Amodei says, quote, no choice but to challenge it in court. Meanwhile, SoftBank is reportedly seeking up to $40 billion in financing to fund its growing investment in OpenAI. To help us break down the headlines, we're calling in for tech support with Yahoo Finance's Dan Howley. Dan, it's great here to be here with you. Let's start with Anthropic, because we've seen Dario kind of sparring with the government there, and they have been seeing record downloads in Claude over the last few days, not only nationally but internationally. But now there's this supply chain issue. Can you give me the legal theory here? Like, what's behind this?
Yeah, I mean, this has been a win kind of for Anthropic, despite the fact that the Pentagon has now officially labeled them a supply chain threat. Now, essentially what that means is that companies that do work with the Pentagon, other software companies, or any company for that matter, if they use Anthropic within the application of their own software with the Pentagon, they have to strip out any Anthropic capabilities. So, for instance, say you're Microsoft and you use Anthropic in your work with the DoD. You can no longer do that in your work with the DoD. Now, that doesn't mean that a company, but Microsoft or Amazon, has to completely strip out Anthropic from any of their offerings more widely. So it's only within the scope of their work with the DoD here, and not necessarily on the private side. So, obviously getting access to Pentagon contracts, absolutely massive, millions and millions of dollars at stake here. But it's not exactly the kind of end of the world for Anthropic by any stretch of the imagination.
Dan, is there a precedent for this? Like, has this been invoked before, or this kind of a new thing?
Yeah, no, this has been invoked with Huawei. There were issues with obviously Huawei, and so the U.S. said, "Hey, nope, we're not going to be using Huawei. Get lost." And so that's the last time we've seen this. It usually is just something that happens with companies from rival nations and things like that. Yeah. I mean, this isn't something that's supposed to be like normally used for U.S. companies, but this back and forth is just seemingly going to continue. We had Dario Amodei, the CEO of Anthropic, put out a letter basically laying out where things are, saying, "Yeah, we're a supply chain threat. We're going to fight this. We'll see what happens." And he apologized for a letter that he had sent to employees, basically calling out OpenAI and the DoD, and kind of to a degree their partner Palantir. So
yes.
Yeah, he kind of went out and apologized for all that.
The tangled web AI weaves here. We got to move on, because I want to get to this SoftBank story. They're seeking a loan of as much as $40 billion, and this is to help finance their investment in OpenAI. So we're sticking with AI here. And SoftBank, they know where the deep pockets are. They've raised maybe trillions of dollars, I want to say before, but $40 billion in one clip seems to be a pretty high amount. So what's behind this?
Yeah, this is to help finance that new $30 billion investment that they're doing in OpenAI, with the likes of NVIDIA getting in there as well. And the fact that OpenAI has become such an important part of SoftBank's portfolio is good and bad. It's good in that, well, it's OpenAI, it's ChatGPT, it's you think of AI, you think of ChatGPT. However, it also means that should OpenAI or ChatGPT not live up to the expectations that it has, $1.4 trillion of spending, the potential for huge cash in when they go public, that would not look good for SoftBank. It's kind of reminiscent of the what was it, the workspace investment that they had. I can't recall.
Was it WeWork? Was that
WeWork? That's it. Yes.
Man,
yes.
that takes me back to the teens. Yeah,
you don't want that. Yeah, and it's I think it's just interesting in that they're doing this huge investment, but there's still nothing proven as far as how much we know enterprises might be using AI. There's still a lot of unknowns when it comes to this. So,
well, let me ask you, Dan. Let's follow the money here, because what was it, 6 months ago, the circular investment story started kind of grabbing headlines here. So SoftBank raising $40 billion, $30 billion to OpenAI, multiple billions of that to NVIDIA, multiple to AMD, and all these U.S. tech companies. So it seems like a lot of this money is going to be flowing into the U.S. eventually. I don't know. I mean, thinking through that, is that possibly a boon for some of these U.S. tech companies?
Oh, for sure. I mean, look, in NVIDIA, they're crushing it, right? We don't know what the future holds, They make the majority of their money, a little bit more than 50% of their money in the data center from hyperscalers. How long is that going to hold out? How long can these companies continue to put billions and billions of dollars into AI? We don't really know. AMD, they're really kind of on the up and up now. They have their Helios racks, so they're going to keep doing that. I think that's absolutely a benefit for those companies, as well as the companies that do the infrastructure of these data centers, the Dells, the HPs, and what have you. It does help Taiwan, though. TSMC,
Yes.
big beneficiary here for AMD. I mean, they're just, basically the folks making all of these chips. But it's not just chips when it comes to these data centers. It's a lot more than just that. So everyone's going to be benefiting. And I do think that U.S. companies are obviously the ones that are benefiting more than most. So it just really depends on, will this continue to hold out this huge amount of spending and this huge amount of demand?
Yeah, and I think a lot of investors are going to be paying attention to the interest rate and the investor interest in this SoftBank debt raise right here. Thank you so much, Dan. We're going to be talking to you later in the show about smart homes. Deep tease there. All right, coming up, Robinhood CEO Vlad Tenev talks the company's new Platinum credit card. Do not go anywhere. Time now for some trending stories, starting with Netflix as it makes a move to acquire Ben Affleck's AI film company, Interpositive. Yahoo Finance's Brooke DePalma joins me here to discuss. So Brooke, this is kind of a nuanced story, but this is about AI post-production. So they're not looking to get rid of the filmmaking workflow like actors, writers, and directors, but tell us about this.
Yeah, so Ben Affleck essentially created this company just a few years ago, and in the statement that the company provided, they said that he wanted to create this business to really preserve what makes storytelling human, which is judgment. He felt that he had a responsibility to their peers in the industry to protect the power of human creativity. But I think this is what makes this really interesting, is that this is coming on the heels of Netflix's major announcement that they're backing out of that Warner Brothers bid.
Yes.
And also, when you think about it, this comes at a time when we are talking about the impact of AI on jobs almost every single day now.
Yeah, I mean, so AI slop gets, I'm not even going to call it a bad rap because it's kind of well-deserved. A lot of people are pushing back, including me, against some of the content on social. It just doesn't feel genuine.
Right.
So,
but it also sometimes is hard to decipher what exactly is AI.
Yes.
And so he's trying to maintain that human creativity within this business, sort of the AI tools to help amplify and help innovate.
yeah, well, I think that's kind of the direction they want to go. So I don't know. There's a certain amount of cost cutting that goes in here. And so if you're Hollywood and you don't want to, already AI is laying off a lot of people, from writers to production people. And so you got to think that they're trying to control the narrative as well with this.
Yeah, and I was reading a note from CFRA, who did put out a buy rating this morning, an upgrade from CFRA on Netflix stock. And they did say that the company's position enables leveraging AI for creator tools and personalization. Many notes that I've read on the street really see Netflix as a key streaming giant. And so it'll be interesting to see what the other streamers do to really make sure that they're staying ahead of the AI curve.
Yeah, and staying ahead of the pushback against AI slop. And we'll get to some more slop in a second.
Right.
But first, let's shift gears here to the U.S. Secretary of Health and Human Services, Robert F. Kennedy Jr., and the latest push in his Make America Healthy Again initiative. And he's pushing back against Dunkin' Donuts, Starbucks, and these are the high sugar drinks that some of them over 100 grams of sugar in one drink. That is a lot. And here's what I love. There's a kind of a pushback here in New England. Do not tread on me. Kind of a throwback to the U.S. Revolution. There you go. So what do you make of this here?
I mean, this is the thing, is that one, let's just say I did reach out to Starbucks and Dunkin' for comment. I did not hear back. I think it's worth noting here that this company is in the business, Dunkin' and Starbucks and every other coffee company out there is in the business of giving options. You're educated. Everything has nutritional facts on it right now if you just look it up on the website.
Yeah, donut used to be in the name.
Exactly. I even found out that a Boston cream donut only has 270 calories today. I'm prepping for this story. So everything is out on the internet, looking into it. I think that there's optionality. There's now more sugar-free options. Dutch Bros had a major push behind that because they have so many sugar-free options that really sort of drove Starbucks and Dunkin' to now need to get ahead. Now Dunkin' and Starbucks both have protein options. It's really about giving consumers an ample variety here, and then you kind of choose what you want with this in mind.
Do you remember a couple decades back, you might be too young for this, but Mayor Bloomberg.
Oh, the sugary drinks.
Bloombito, he caught huge flack for imposing a sugar tax.
What was it, like 20 ounces?
Yeah, it was, on those big giant gulp drinks.
Right.
So he got a lot of flack for that. I don't know where it went, but I wasn't even living in New York at the time. But
you heard about it.
Yeah, because I watched Saturday Night Live. Yes.
But definitely be interesting to see. I mean, people can choose what they want. There's more options out there. Optionality is everything right now. And I understand this is all part of a push for more protein, push for more healthier options. So I get it both ways.
Yeah, all right, let's talk some slop here, because elsewhere in the food industry, fast casual struggling to capture consumer wallets. And so we have a number of companies that surround most of the offices in Manhattan here. And I've seen lines out the doors over the years, but truthfully, I haven't seen those lines lately at a lot of these establishments. I'm not going to call anything out here, but give us some names that were reported with some hard facts.
Yes, so Cava, Sweetgreen, Chipotle, those are the kind of names when you think about quote unquote slop bowls here. And what we saw as of late, as you can see on your screen, is that same-store sales haven't been performing as well as what they used to be at one time. And if you take a look at foot traffic, that has a lot to do with it. Cava saw foot traffic down about 1.4%, Sweetgreen down about about 13% when it comes to foot traffic. And then we also had Chipotle, which actually did post a bit of an increase in foot traffic as of late, but their average check size didn't grow too much. So it's really sort of a combination of factors. You have less people going to the stores. You have more discerning customers. That's what many of these executives said on their earnings call. They're really picking and
Pushing
choosing.
back against $20 lunches.
Exactly. They're being more discerning about where they're spending their money. And then on top of that, too, this caters to a pretty younger customer here who has been struggling. We heard today from the BLS report that the unemployment rate for young people, 2024, is still around 7%.
Nice way to tie in the jobs report.
Right? We got to link it all together, Jared.
Yeah. Yeah, and for the record here, I find what I'm calling slop, I find very tasty. And I
would agree.
Yeah, I had a bowl for lunch. Meat over rice can't be topped. It just has to be done a few different ways. So, Brooke, thank you so much for stopping by.
Of course.
And Robinhood CEO says retail investors not having access to private markets is the biggest inequity in finance today. Vlad Tenev has been speaking to Yahoo Finance's executive editor, Brian Sazi, on the launch of the trading platform's private company retail fund. It has already raised over $650 million. They spoke about the fund's launch, Robinhood's new credit card, and much, much more. Let's take a listen.
One of the biggest problems, I think the biggest problem in capital markets today is that retail investors don't have access to private companies. I think it's one of the greatest iniquities that is in the world of finance today. And what you're seeing is private companies raising capital and getting up to valuations in the hundreds of billions or more, completely outside of public markets where normal people can get access to them. So the days of being able to buy an Amazon or a Microsoft and get in at valuations in the hundreds of millions, potentially see 1,000x or more return in the public markets if you're a retail investor, seem to be getting further and further away. And Robinhood Ventures really aims to solve that problem by opening up access to private companies for retail investors, and not just opening them, but I like to say blowing them off the hinges so that they can't be closed again. So it's going to be a long journey. It starts with the single first step of Robinhood Ventures Fund 1 going public on the NYSE. And we're contributing a seed portfolio with companies like Databricks and Stripe, which we recently signed. Aura, I'm wearing the ring right now. Mercor and Boom Supersonic, which is making a nice jet. So we've got some frontier companies at the frontier of their industries. And with the new capital, we'll continue to invest and accelerate that activity and keep working hard to open up this elusive asset class to the mass market.
Vlad, you know so many founders in tech and just founders in general. When you talk to them, why are some of these companies staying private for longer? Is it exciting to go public? Yeah, I know you got to do quarterly earnings calls. You guys have managed to reinvent your earnings call, and I tip my hat to you. I mean, you guys have done a great job of that. But why aren't more companies going public?
Yeah, I mean, the fact of the matter is there's two problems. One, no, most founders are not excited about going public. And if you go around in these circles, everyone's just complaining about the potential of having to do it. And some people are saying they never want to go public. They want to stay private forever. I think there's a branding problem and also some legitimate problems with, you have all sorts of restrictions, the legal hurdles, the expenses. It's not easy. Of course, we're a proud public company. We kind of stand for public access. So we're trying to do it a little bit differently. And we think we can help at all stages of the journey. So we offer products for companies that want to make their earnings calls more exciting. You might have seen a couple months ago, Open Door actually live streamed their earnings on Robinhood app and also used our Say technology to take questions from retail investors. We have our IPO access offering, which allows retail to access IPOs, which was actually used for Robinhood Ventures. And then, of course, Robinhood Ventures itself, which even if you don't want to go public, we would like to open up private markets for retail exposure. So we're trying to attack this systematically from all aspects. And the New York Stock Exchange, the administration, they're all interested in solving this problem. Matter of fact, just last time I was here on the New York Stock Exchange floor, there was a panel discussion with Chair Atkins called "Make IPOs Great Again." So we're obviously pro IPO, and even if companies choose to delay that, we think retail investors shouldn't be left behind, and we're working to change that.
Amen to that, Vlad. Talk to me a little about, this has been a big week for you. You had the platinum card drop. It's a heavy card. It's made with real platinum. That is another, that joins your other card that you had too. But talk to me about this family hub that you guys are focused on.
Yeah, the Family Hub, I think, is the most exciting product that we actually unveiled. I mean, it's the most exciting for me. I've got a bunch of kids, and I'm tired of using another financial firm with my family. So I'd like to bring all of that activity to Robinhood. Finally, I can do that. And a lot of our customers have felt the same. It's not just me as the founder and first customer, but yeah, basically what it allows you to do is share your finances with your family members, open up accounts for your children. You'll be able to open up accounts for your spouse, for parents, and everyone's finances can be viewed in one hub. And you can even, manage other people's accounts. You might have seen in my demo, we have the ability to, if you link your spouse's account, place trades with their knowledge. You can't do it secretly, but place trades in accounts of your family members. So I think that it's one more step in our journey of making Robinhood even better for you when your whole family is on it. We see a big opportunity because over 100 trillion in assets are going to be changing hands from older generations to younger. And that'll just be simpler if they're all on Robinhood already. So that's what we're working towards. And we're getting there. For the past 12 quarters or so, we've had net inflows from all of our brokerage competitors. We expect this to just be a further tailwind to that.
Vlad, I'm listening to you, and I can't help but to think, wow, I really got screwed as a kid because we had none of this innovation back in like 1984. Maybe we did, my parents didn't know about it. Lastly, one thing I know we didn't have when I was a kid are these Trump accounts. And tell me if I'm wrong, but I view July, I think, when these Trump accounts become available as a real seminal moment for investing, for investors, for the next generation of investors. What are your thoughts on these Trump accounts, and will Robinhood play any role in them?
We've been a supporter of the Trump accounts initiative from the very beginning. I remember actually on Robinhood's roadshow, we spoke to Brad Gerstner at Altimeter Capital, ended up becoming an investor. This was back in 2021, and he was talking about how, he had this vision of every newborn in the country getting an account funded by the government so that they could start their investing journey, and that it's not just, good for the individual, but also good for society to have more people buying into our capitalist system. So, hats off to Gerstner, and with the support of Michael Dell and many others, they persevered. Here 5 years later, this thing is real. And we're lucky to be a part of the initial Trump Accounts Summit at the White House last year. And I've said to the president personally that, Robinhood is here, ready to support the program, however we can be helpful, and we have technology resources and people that can do whatever is necessary to make the program a success.
Coming up, we bring you the latest edition of Goodbye or Goodbye. Stay tuned. Welcome to Goodbye or Goodbye. Our goal, to help cut through that noise to navigate the best moves for your portfolio. I'm here with Domini Impact Investments CEO Carol Leibel, taking a look at industrials. And Carol, you are bullish on Quanta Services, and this is a specialty contractor in the energy and communications infrastructure space. Think AI, think data centers, and not a surprise, this chart is from the lower left to the upper right, but I'm guessing you think there's more opportunity here. So let's get to your 3 reasons, starting here.
Yeah, so the secular growth that we're seeing, as you mentioned earlier, tied into AI, very energy thirsty, data centers, and providing that opportunity in that sweet spot that Quanta Services services.
So we've seen a lot of companies in this space, and there's been some questions about too much money flooding in. Are they overbuilding it? Is that not one of your concerns?
So no, what we're seeing is that as we need more energy, we're also seeing that the grid is aging, and we really need to modernize. Again, a specialty of Quanta Services. So, Quanta able to support that reliability, the resiliency, and help to bring that onshoring of factories and renewable energy.
All right, well, let's get to our second, best-in-class execution. So you're liking what management is doing here with the company, I'm guessing?
We do. So they are able to really shift from these sort of competitive, bid-heavy contracts to long-term partnerships with the hyperscalers and the utilities, giving them that sense of stability, transparency, and future earnings.
So the biggest companies on earth are giving them long-term contracts, and that gives you a little bit of peace at night.
Correct, and gives them the ability to earn higher profit margins.
Okay, well, let's get to your third reason here, solid financial metrics. So tell us about the company's financials.
Yeah, strong balance sheet and net debt to EBITDA, which is really healthy. We're seeing that well below the 2.5 times. It's sort of that threshold that we're looking at for concern, giving them bandwidth for future acquisitions to help add value in the future.
Okay, well, let's get to some of the potential risks here. And we've got a few. Project execution, let's talk about that.
Yeah, so that growth, Quanta has been able to build a $44 billion backlog, which is a record for them, 27% higher than their backlog last year. And in fact, management is predicting this year is going to be 2026 is going to be another record year. But a lot of that growth is priced in. This is a stock that's not cheap.
That chart was from the lower left to the upper right.
40 times earnings. So management really needs to execute on those projects in a very solid way so as not to make investors nervous.
Priced to perfection, that's what I'm hearing. All right, let's talk about mergers and acquisition and any integrations there.
Yeah, so they're really able to add value through that using some of that cash flow and some debt to build. This is a business that's really been built on quite a bit of acquisition. I think they've done over 150, and management has done it well.
Okay, well, that is a lot of acquisitions, but you're liking the stock. Let's move on to a name that you're not really that big on. This is Wolters Kluwer, and I hope I pronounced that correctly. I'll tell you what, I had to look this company up. I was not familiar with them. I do know how to read a chart, though. That is from the upper left to the lower right. That's kind of the mirror image of what we were seeing before. So let's tell us what you don't like about this company, reasons to avoid.
Yeah, so both of these companies, both Quanta and Wolters, are in the industrial sector, but as you can see, 2 very different results. Wolters Kluwer is in the software and information business. They provide information to legal, accountants, healthcare workers, compliance. And we're a bit concerned about the AI threat here.
I mean, that space just blew up a few weeks ago. But this company has been on the decline for over a year.
Yeah, so software has been a bit under attack. There is a question of how AI is going to affect that software as a service model and even the per user licensing business model. If there are fewer workers or if the economics of licensing those per user seats becomes too high, companies may choose to go to internally build it themselves with some AI agents.
Yeah, we've heard that. We got to move on. We're running out of time. I'm having too much fun here. Margins uncertainty. Talk to us about that.
Yeah, so they're going to need to invest in developing their product. So that's going to take money out of the bottom line. That's going to put pressure on the margins.
Okay, we actually have one more here, growth rate doubt.
Yeah, so as I say, how many workers are in their seats? Do companies decide to go it alone? Are the renewal rates what they were? What is the timeline for that? Yeah. Is it a year? Is it 3 years?
Okay, let's say that what can the company do to kind of turn your opinion around?
Yeah, so I think if we see they're really able to lock in a nice partnership with an AI platform, that would give us confidence that it's going to be easier for a user to license from them than to go it alone.
All right, we are out of time here, but thank you for stopping by, Carol.
Thanks for having me.
You bet, and thank you all for watching Goodbye or Goodbye. Coming up, we're going to bring you the closing bell on Wall Street. Stay tuned. Stocks ending the day and the week in the red. Let's get straight to the Wi-Fi Interactive here. Here is the Dow down almost 1%, 450 points. I'm going to show you the intraday price action. A lot of red there. We did get that non-farm payroll report, the big jobs report this morning. Second worst since the pandemic, but there are bigger factors at play here. We've been dealing with macro geopolitical headlines, war headlines all week long, and there's that big spike down we saw on Tuesday. And guess what? We're finishing pretty close to the lows of the week. That's something that you don't necessarily want to see. You can also see this in the NASDAQ. We're down about 1.24%. Tech was actually kind of a bastion of strength, especially big tech. And then here's the S&P 500 down 2%. And if you've been watching me during the week, I was watching 6,800 like a hawk, saying we can't close below it. Guess what? We just closed below it right there. So moving on to the small caps, Russell 2000 down 4%. You can pretty much say that rotation trade from the big caps into the small caps, that's kind of looking like it's over right now. And one more thing, we're going to talk about the VIX in a minute here, but I just wanted to show you where the VIX is, trading at about 28, and that is towards the highs of the week. So that's really not how you want to end the week. So let's take a look at some of the sector action. We're going to deal with the large caps here, excuse me. And you can see at the top a couple of green sectors, but they are defensive. Energy's been doing well all week. It's it's been doing well all year, and so that's one of the beneficiaries. Staples, which was one of the great trades in January, that picked up at late day. So you see Staples up about 42 basis points, and utilities and healthcare, all those four sectors are kind of defensive in nature. What didn't work the most, tech down 2%, materials, consumer discretionary, all three of those underperforming. And we can see that here in the NASDAQ 100. Not a lot of green here, although a few green names, because I'm going to show you software in a second, what software did. First, I want you to concentrate on the mega caps. NVIDIA down 3% today, Amazon, Meta, Tesla down 2%. But let me show you over the last 5 days, and you can see, well, there is a little bit of green here, so it wasn't all bad. And if I show you what happened with software this week, you're going to say, wow, I wouldn't have expected that, at least I didn't. It was, if you follow the IGV iShares ETF, that was having its best week in some time. And we know that software has been under a tremendous amount of pressure since last October or so. But here is the semiconductor space. Aside from Broadcom, which had earnings this week, and NVIDIA, which is almost flatlined there, a lot of red in this space. So the fuel, the chips and the shovels, there we go, the picks and shovels of the AI trades flagging just a little bit. Want to show you what's happening with the Dow as well. This is another 5-day view, and I'm going to sort by performance here. A lot of industrial stocks got hit late in the week, and if you remember on Monday, we saw energy stocks in the green, we saw defense stocks in the green. Well, that faded quickly, and I can't repeat this enough. There really is no playbook for these big geopolitical conflicts, especially since we don't know how long it's going to drag out. And guest after guest is telling me it's probably going to be a bit longer than we were thinking 5 days ago. So here, the biggest loser this week was Sherwin-Williams, followed by Caterpillar. That has been one of the best trades in the Dow over the last year. Nike down 8%. We've seen foreign stocks absolutely smash. Nike has huge China exposure. Procter & Gamble, that is a Staples trade. That didn't do well. That's down 8%. 3M, that's another industrial. And then healthcare. So you put it all together, wasn't the greatest week for stocks here. But I do want to dive into the volatility we've been seeing in the market this week, because Henry Schwartz is here, Vice President of Market Intelligence at Cboe. Henry, it is great to see you. I'm going to reset the board. I want to talk about the VIX with you, because Cboe calculates the VIX, and maybe you can break down for us. I was talking to a number of people Monday, and they were surprised that the VIX didn't top 30. In fact, even today, didn't top 30. And if I show you a one-year chart, this is going to show those post-Liberation Day spikes there. That went up to almost 60, and this looks kind of tame by comparison. What do you think's going on?
Well, you could say it's tame, but we are the highest we've been since that Liberation Day kind of moment, right? So we've blown through that kind of November AI sell-off. In terms of volatility. And I think traders have been a little bit kind of, lost in terms of how this is going to play out. I mean, Monday, we sold off hard in the morning, yes, right? But we really recovered.
Yeah,
and then,
Tuesday
we were
too.
Green on the day, and people are like, okay, maybe the market doesn't actually care. I think you just really have the pendulum swinging really kind of between fear and some greed. But at this point, kind of seeing what has been selling off, and to see the energies, energies doing fine, but to see the metals get hit as well, and even crypto, it's kind of a risk-off moment. People are like, I'm not exactly sure what's going on. Get me out. It's interesting to kind of see this dump into a Friday afternoon. I mean, last Friday, that was, this has been exactly a week. So I also think there's some kind of hesitation in terms of like, we don't really know what's going to come out of this weekend.
Yeah, I think it was another Friday not too long ago. We were celebrating Dow 50,000. That seems like eons ago. So one of the things about the Cboe Volatility Index, and when you see it spiking there, some people call it the Fear Index. I do have to note that Steve Sosnick over at Interactive Brokers says all the time, it's not a fear index. It's an institutional gauge of risk aversion, because this measures S&P options over 30 days. Retail traders are maybe 1 day, but we do have a 1-day VIX, and let me show you what that's looking like here. So we saw it pretty muted on Monday and Tuesday, the 1-day VIX, but now you're seeing it kind of spike up here. So give me your kind of breakdown between what we're seeing in the 1-day versus the normal 30-day VIX that we usually take a look at.
Absolutely. Well, Steve's exactly right. And to just purely call it the fear index is you're really missing kind of part of the function.
The SIBO does not condone this.
We don't call it the fear index. We call it the VIX. But some people call it the fear and the greed index because there are times where volatility is lifting, but it's lifting more in terms of people looking for calls. In fact, we did see that around Liberation Day. And so there was a little bit of a hint that it was the upside move that was kind of on people's radar. Now, the VIX one day is the exact same calculation. It uses an entire strip of the SPX options, but it uses those 0 DTE options, that are very, very popular, make up about 2/3 of the SPX volume.
Is it fair to say that that is kind of a gauge of the retail trader then versus institutional, or is that oversimplifying?
It's about half of the activity is retail, but what I like to use, that VIX one day is a great measure basically of what the expectations are for the next trading day. So to see it double where it was just a couple weeks ago, what that's telling you is in dollar terms, if the straddle, which is basically buying a call and a put that kind of are your indication of how far the market's expected to move, well, the cost of both of those options is doubled. So basically, it makes sense. People are expecting to see moves closer to 1.5% versus what we were seeing 2 weeks ago, which was moves that most moves were basically barely 50 basis points.
Yes, and while you were talking, I put a year-to-date chart on so you can see this spike in relation to what we were seeing the rest of the year. You mentioned something really interesting that I wanted to hit on with another VIX, and this is going to be of the gold market. So here's the SIBO Gold Volatility Index, and you mentioned that sometimes when stocks are moving up, they can also do so with volatility, and that's a signal, but that's kind of rare. Now, the SIBO Gold Volatility Index tends to move up as gold rises up. That's the historical norm. And here's that big spike up in gold. That was a record high in late January. And then we saw the price actually plummet, and so did volatility. And now we're just kind of meandering sideways. So talk to us about what you're seeing in the SIBO Gold Volatility Index.
Sure. So the Gold Vol Index is the exact same calculation method. It's applied to GLD options, but you get the exact same measure. And with commodities, whether it's gold or any other metals, and in some cases energy, when there's a panic, these things usually spike to the upside. So the put wing that we see in, the correlation between market movement and volatility for stocks is market starts to really sell off, people panic. Well, when the market starts to, when things get really dicey, people actually kind of bid up these commodities. So it makes sense that you kind of have the correlation is positive between volatility and price movement in the metals because it's a commodity. But I mean, I'll tell you, I was just looking at that. That January activity in gold and silver was relatively insane. I think it's the last time I was here.
Yeah, I think it was right around that time. Here's another one. Here's the crude oil VIX, and this is based on what, WTI options, or is it USO options?
I believe it's on USO.
Okay, so USO is an ETF that tracks crude oil, but suffice to say that it's really come alive recently, but it's actually been trending up over the last few weeks, and was it a leading indicator in any way?
Well, I did look back, and volatility actually in kind of everything that we look at. So the S&P, stocks in general, energy, gold, it's been trending up kind of pretty steadily since the end of December. So, I think the timing on this might have been a little bit of a surprise, but it was not, we saw kind of the assembly of military might in the Gulf, so we kind of knew this was coming. We didn't know it was coming 2 weeks ago or 1 week ago. What you have now is definitely a higher volatility regime. And as you said, we're not quite sure how long this one's going to go for, right? So, every time traders say, oh, well, this time it's different. Most of the other volatility spikes we've had have been really brief, within, and they actually kind of tend to get shorter every single time. This one feels like it actually could be a little different just because of the fact that, we know where this is all coming from, and it has to do with the ability for oil to get out of the Gulf. And kind of, the chess game that's going to be going on in terms of, the geopolitics. So, it looks like this is going to kind of, it's definitely going to be choppy for a while. It'll be really interesting to see how it goes next week.
Yeah, and I put the VIX back on, and you mentioned December and things kind of trending up since there. So yes, as the S&P 500 was going sideways and stocks were kind of going nowhere, guess what? Volatility that was getting priced into the market here. I don't want to spend the entire 7 or 8 minutes on the VIX and various VIXs, although I can't believe we just did about 6 minutes on that. Let's talk about the S&P 500 here, because this is a market, I'm going to put a 6-month chart. This has been going sideways, but we just broke a really big level at 6,800. That was my line in the sand. What does this mean to you?
Well, if you look at kind of year-to-date performance, as you said, it had been kind of this story of small cap outperformance, which was probably driven by the fact that, people really felt like rates were going to be coming down. That's good for small caps and industrials. S&P was kind of hovering. We were up, I think, almost 2% at the peak. And that, we're actually down now, I think, about 1% year to date.
Yeah, 1.5% gave up all the gains.
So, we've had a really strong bull market. People, I think, have gotten a little complacent. You just kind of put your money into broad-based indexes and you just assume it's going to keep going up. We haven't really seen any super shocking moves to the downside. This has been, I think this is starting to test investors' patience. But I think it's going to be, a little bit of a tough slog as things work out.
I'm wondering, because we saw the Mag 7 kind of catch a bid this week. At least they weren't selling off strong. And then I mentioned before the software sector having one of its best weeks in forever. Like here's software, here's what it did today. I'll give you the full 5-day view. That's a lot of green. So what if the Mag 7, what if software kind of got going again in spite of all this risk? Would that be enough to prevent the industrial wipeout from kind of gaining too much steam in the S&P 500. What I'm wondering is, does this turn into a bear market, or can the Mag 7 and maybe some of tech keep it alive?
Well, a lot of these names got really expensive in a PE, frame, and everyone was talking about it. Right? There's a lot of headlines, in January about this is getting a little nuts. We had names trading 50, 70 times earnings, 100 times earnings for Palantir. There was a pretty solid correction there. A lot of these names, even though we've seen a good bounce, some of them are still 40, 50% off.
Yeah, let's do
Palantir
highs. 3 years here, and that doesn't look like a big drop off the highs. But if I put a 1-year chart, you're going to see, there is a decent amount of
big move. You're going from 210 back down to 140. We've seen it in other names as well.
Yeah, you can see that on the 3-month. But and there are other names that have just been absolutely decimated. And I'm just kind of clicking here randomly. But CrowdStrike, which was a darling stock, that is just kind of it's up 23% over the year, but it was up multiples of that before.
Yeah, there's been I think the pullback in some of these names is kind of a healthy kind of reallocation of capital. And then that really was the story was pretty clear when these names were selling off, but the small caps and Russell were dramatically outperforming. At one point, Russell was up about 7% year to date, the Russell 2000 index, and the S&P was barely up 1%. So when you get kind of these moments in the market, it's everybody's kind of reallocating capital, reshuffling the cards to figure out where they want to put on some risk. Whether the tech names, the Mag 7 and the Mag 10 can pull us out of this. Certainly the diversification effect is important, and there's some very high cap names in the tech sector, so that'll help. But I think that the truth is when investors are scared, whether they're retail or institutional or multi-billion-dollar PMs. They kind of have to sell a little bit of everything, right? That's what people do.
De-risking, you got to sell a little bit of everything. All right, Henry, we got to leave it there. Thank you so much for participating in our VIX discussion.
Awesome.
More on that later. But coming up, SoundHound AI, the CEO joins us next. Do not go anywhere. Let's turn our attention now to a trend we've seen for much of the year so far, the AI trade. Software stocks especially have taken a beating over fears of AI disruptions, not necessarily this week though, but companies like SoundHound AI is no exception. Its stock is down over 15% year to date. Still, the speech recognition and Gen AI company issued upbeat guidance for the year, and the company's CEO, Kayvon Mohajer, joins me now. Kayvon, thank you so much for stopping by here. Let's talk about these results. Tell us about your company, because I know you've pivoted over the years. Your ticker first came on my radar around the ChatGPT moment in 2022. What have you been doing?
Well, first of all, thank you for having me. It's great to be back. SoundHound is a voice and conversational AI company. We believe speaking is the most natural way to interact with devices and services. We also believe we are entering a new era where every product needs an AI agent and every business needs an AI agent. And SoundHound provides solutions for both devices and services.
And so you're doing a lot more than just transcribing here. You're integrating audio in a number of different ways. And I understand you've done a lot of mergers and acquisitions over the last few years. So tell me what your tech is enabling you to do. What's the future? Tell us where your product's going to land here.
Yeah, SoundHound is more than 20 years old. I was one of the co-founders in a Stanford dorm room in the early days. And it started from speech recognition. But at that time, we actually, with my co-founders, thought, what do they have in Star Trek that we don't have? And they have a lot of things. But the one that was what we thought we can do was talking to robots and computers. And so it's not just about speech to text. You also have to understand the meaning behind the voice, and that's basically voice AI. When you combine speech recognition and natural language understanding, we spent a decade building core technology that we are very proud of. We believe is the best in the world, and we unveiled it about 10, 11 years ago. And then we went into cars, we went into customer service, and now we are in millions of cars and TVs, and we are in thousands of enterprises, from 7 of the top 10 financial institutions to insurance companies to hospitals and universities, and all the way to a single location restaurant.
Yeah, I'm still waiting for that Star Trek holodeck experience. Maybe that'll come in a few years. But I understand you're getting into some interesting industries here. One of them is those quick service restaurants, fast food. As I understand, and correct me if I'm wrong, half the time I can't understand what the person on the other side of the speaker is saying, but AI is figuring it out, and you're integrating that into order management, or how does it work?
Yeah, I'll tell you two cool things. So first, automation of ordering, whether you call a restaurant or go to a drive-through. And when you call, actually, a lot of restaurants don't pick up the phone because they're busy doing other things. So with our AI, no call goes unanswered. We pick up the phone right away. We are very patient. We speak multiple languages. We take the order. We upsell so we can actually increase the ticket size. And then for drive-through, again, it's going to be all automated. We are live in many locations. You go in and talk to an AI, you can actually talk in different languages and it can understand you. Once we had our large footprint in restaurants and large footprint in automotive, we introduced our voice commerce, which brings them together. So if you're driving your car and you are talking to your car to do navigation, maybe ask for weather, ask other things, and that's powered by our AI, why do you actually have to go to the drive-thru and wait in line? You can actually talk to your car. The agent in the car that's powered by us talks to the agent in the restaurant that's also powered by us, and you can order in advance. And that's the voice commerce, the third pillar of our business that we recently introduced. So we generate new leads for the merchants that power us from the devices that we power. And that's net new users. We generate revenue from that. We share the revenue with the device makers, car makers, and TV makers. And that's going to create a flywheel effect for us.
The future is here. That's all I can say. And I understand you're in a broad array of industries, from healthcare, financial services, insurance. Talk to us just a couple minutes ago about the future here of your company. Any headwinds that you're trying to overcome? What's your message for investors there? Places where you really want to buckle down and straighten things?
What we constantly balance between investing in growth and investing in innovation. And obviously making sure we are very close to profitability and we don't overinvest. And we've done a great job. Our company has a very strong balance sheet. We have zero debt, and our revenue is growing. Last year, our revenue was up 100% year over year. Q4 was up 60%. All the profitability metric improved. We also had another record in Q4. We had the largest number of customer deals signed in Q4. We had more than 100 customers signed. And we are starting a year with a huge pipeline. So I think it's more tailwind, to be honest, than headwind.
Okay.
It used to be like 3 years ago, we were knocking on doors to get a POC. Now they're knocking on our door, and the budget is not coming from the innovation budget, it's coming from the IT budget. So the AI transformation is a mandate, and we are the right partner for all the customers.
All right, knocking on your door is a good place to be. I wish you all the best. Thank you, Kivan.
Thank you for having me.
Time now for What to Watch. Another big week of earnings on deck with software names like Adobe and ServiceTitan. And across the retail sector, we have Kohl's, Dick's Sporting Goods, and Ulta. But the marquee report is coming on Tuesday with Oracle's third quarter earnings. Investors are going to be watching closely for any updates on AI demand and data center spending. Analysts expecting Oracle could raise its capital expenditure outlook as it races to keep up with AI workloads, projecting roughly $60 billion in capex over the next 12 months as the company expands cloud and AI infrastructure. Investors are also going to be listening for commentary on Oracle's massive $523 billion revenue backlog, and that's including a large portion tied to OpenAI contracts. Over in retail land, we got Dollar General, the General reporting fourth quarter results on Thursday. The discount chain has been seeing steady growth in traffic as higher income shoppers continue to trade down. Analysts expecting mid-single digit revenue growth driven by new store openings and improved in-store execution. And on the macro front, a key inflation print coming out on Wednesday from February's Consumer Price Index, or CPI. Economists forecasting the headline inflation number to rise 0.2% and the core number, which takes out food and energy, up 0.3% on a month-over-month basis. Any surprise could shift expectations around the Federal Reserve's path for interest rates later this year. And moving over to housing, the latest data on builder sentiment and home sales is due out Tuesday. Economists expecting the NFIB Home Builder Optimism Index to tick slightly higher to 99.6. Meanwhile, existing home sales are forecast to edge down to an annualized rate of 3.87 million, suggesting the housing market remains constrained by higher mortgage rates. And coming up is Asking for a Trend. Stay tuned. Hello and welcome to Asking for a Trend. For years, the tech industry promised us the smart home, a world where your lights, thermostat, coffee maker, they all talk to each other. But for most people, including me, it never quite worked out. Too many apps, too many devices, and someone in the house always ends up becoming the unofficial tech support. That was me too. But now, industry leaders like Amazon and Google are saying that artificial intelligence might finally fix all that. And joining me now for more is Yahoo Finance tech editor Dan Howley and senior housing reporter Claire Boston. So thank you guys for joining us here on a Friday afternoon. Dan, let's go to you first. And the smart home, okay, it wasn't exactly what it was promised to be in the beginning, but now the tech is kind of finally catching up. Tell us about that.
Yeah, there's a bunch of different capabilities that are coming out from the likes of Google and Amazon. Amazon had relaunched Alexa. It's called Alexa Plus now. And they launched some new capabilities alongside of it. The gist of all of this is that, AI should be a helper when it comes to either setting these things up or making sure they're, working together, talking to each other more easily. It's just still not exactly the easiest thing in the world. And, look, like you said, we've been talking about the smart home for some time.
My entire career here at Yahoo Finance, 10 years, 1 decade.
Yeah, I tried it. I live in it. It's not really great for an apartment in New York. I can't automate locks here. The landlord would probably get upset. But, different things you can do, lighting, plugs. And I know some people who are power users who, get a lot out of it. One of my best friends tells his computer to turn on and off and his TV to turn on and off, and Alexa does it no problem. But I think for a lot of people, it just ended up being too difficult to kind of put everything together and get it set up.
Yes, and Claire, I want to come to you on that. So how is it finally getting to the stage where people are able to take it out of the box and set it up? How is AI kind of bringing this forward?
Yeah, so at this point, I think we're still stuck with a lot of those more legacy technologies. Like you, I'm someone where I was told I could download an app and it would make my lights turn on and off, and I just never bothered because I didn't want to figure it out. Maybe AI in the future will be able to make it a little more seamless, but right now we just have this app ecosystem that is very complex. And what I think is interesting is we've seen that home buyers just don't really seem to care about smart homes when they're trying to make a purchase decision.
That's interesting.
It's not like a value add or a subtracting value. It's just kind of a non-issue, at least right now, when you look at all the things they care about.
So that was actually going to be my next question. So is there some kind of service industry where people are coming in, maybe Dan, and that's their specialty, and people will hire these people to come in and outfit their smart homes? Is that going to go away now that it's becoming easier? Well, how does that stand?
No, people are still going to need help. And, to Claire's point, it's interesting because, if you look back a few years ago, there were, different electronic panels installed in people's homes, and now they're just kind of obsolete. It's like, oh, cool, I have this hole in my wall or blank thing in my wall that does nothing. It's, lived in an apartment a few years back that just had a doorbell in the kitchen. It's the same idea. I have no idea what it was for. Doesn't serve a purpose now. Now it's just there.
Dan, what about what about interoperability? A lot of these systems, they don't talk to each other, and it's like you kind of got to go all in on one to the exclusion of the other, and just not. It's something that I never wanted to deal with, honestly.
Yeah, there's some standards where different companies will have their things work and be able to talk across different operating systems, but it's still this just mess of too many companies, too many different types of products trying to line. It's like getting a box of Legos and no instructions, and you're like, okay, I guess I got to figure this out now. The imagination element isn't exactly something you want to do with your smart home. You want to be able to just put it together really quickly and efficiently.
And Claire, talk to us about the housing market. We've talked about it being frozen for some time, and I'm wondering if is this a demographic thing? Like if we had more buyers in the housing market, especially younger home buyers, would they be more interested in that value add of smart homes?
Yeah, so hypothetically, I think the power user in a smart home is going to be that younger client. That being said, I think the thing that those younger clients care most about is affordability. And when you think about adding the smart home technology, especially if it's really, really integrated, it's not that cheap. And so I think a lot of buyers today are just like, get me in at the lowest price for a home that meets my needs, and I will figure out the rest. This is the kind of thing I can upgrade later.
So is it easy to make those upgrades? Can you just kind of start with a baseline, like here's an Alexa, here's a Siri, and just kind of build devices off of that? Or do you really have to, if you want to use it, is a good experience that you kind of got to jump in a little bit more?
Yeah, I mean, I think it's a pick your poison. Like a lot of smart homes are as simple as just having Alexa control the lights or something like that. Or the one that I have heard of is you can get an app to control your oven. So like when you freak out and you leave and you think you left your oven on, that is something you can do.
That peace of mind, you can't put a price on that.
But that being said, some of this stuff is highly complex, and that's kind of when you need to bring in an expert to kind of sync it all up, and that will not come cheap in the modern era.
Dan, be honest with us here. Are you the designated tech expert in your family, and do you resent that at all?
Yes, I am, and it depends on who I'm talking to.
Yeah, the uncle at the Thanksgiving dinner table. But but I guess my point is, and I was going somewhere with this. Are these tech hurdles, are they insurmountable? Do you see AI really crossing the threshold of being able to realistically help people make this technology easier, or is it just like too many devices and people don't want to mess with it?
I think there's a time will come where it does make it actually a lot easier. And I think to, navigate and understand, look, you can use AI and ask it how to set things up, and it will, for the most part, help you with it, not necessarily doing it for you, but explaining how to do it. And I think, when the smart home idea originally came out, we had these insane pie in the sky products. I don't need a camera inside of my refrigerator to show me a screen of what's inside of it from the outside. I can just open the door. There were a bunch of products that just didn't make sense at all. And so I think that's pared down a lot. I do think that AI will eventually make it a little bit easier, but I don't think that it's ever going to be as simple as putting a light bulb in. Anytime you have to get tech involved for something that's relatively simple like that, it feels like it's just an add-on for no reason.
Claire, I did want to give you the last word in case you have anything else to say to the viewers here.
Okay, so my thing that I'm curious about, I don't know the answer to this, but we're promised this idea of agentic AI, right? In the future, AI will know what you want and it will do it for you. So in the future, maybe the AI will know that I want my lights turned off at a certain time, and they will be able to do that. And maybe that will be the true value add that we're missing and get us past this moment where we're just asking Alexa to,
love that.
Do that.
Yeah, because what I've heard is in the future, you're only going to have one app and it does everything. And it's called AI. Claire, Dan, thank you so much for joining us. And everybody at home, stick around, much more for Asking for a Trend. We have more to come. General Motors breathing life back into the ZR1 with its latest iteration, the 2026 Corvette ZR1. Yahoo Finance's Praz Superminion joins me now to discuss. And Praz, I got to tell you, I remember 30, 40 years ago, I was literally drooling over this car, and you had a chance to sit in this latest edition. What is it, 1,000 horsepower?
Yeah.
How did that feel?
I mean, when I was a kid too, there was the King of the Hill ZR1 that was, late 80s, early 90s, and Michael Jordan had when I grew up in Chicago.
Right.
It was so cool. And I'd have the chance to drive this ZR1 was, kind of a dream come true for me to kind of go from those days to this newest ZR1. I mean, the thing with this car though is it's night and day, right? It's basically the king of the hill is back, in my opinion, Jared. You mentioned 1,000 horsepower. We're talking about a twin turbo V8 engine. Look at the styling of the car is very alien-like, but that means it's got great downforce, great aerodynamics, unbelievable grip, and you just turn in, that car just turns where you want it to go.
Yeah, I was going to ask about your test drive.
Yeah.
What stood out?
Yeah. So basically, off the top, just immense straight line speed, just 1,000 horsepower. The rear wheels only. It's pretty nuts. It was kind of scary fast, and I was on public roads, so it couldn't go too crazy. But I think what also stuck out to me, Jared, was the fact that you go into a sharp turn, just turn the car, it just turns flat. There's no wallow or no push. It just goes where you want it to be because it's a rear engine mounted car. It's just an unbelievable performance machine that GM makes. For $200,000, which I think, in my opinion, I think is a relative bargain. Now, it's a lot of money, but if you can afford it, I think this car is an amazing value.
Talk to us, compare it to EV, for instance, because I remember when the Tesla first came out, it was moderately priced versus a Lamborghini, for instance, but it just had insane pickup.
Yeah.
And how does the pickup compare and the handling compare in a high-performance EV versus a ZR1?
Like a Tesla Model S Plaid would actually either tie it or beat it from a 0 to 60 time, right?
That's amazing.
Sub 2 seconds versus 2.3 seconds. So EVs are quick as hell. But the Corvette would dust it on a track, right? It just can't hang with the Corvette's ability to agility, high-speed cornering, braking at the last second. The Corvette is basically a supercar, right? Mm-hmm. And that's where I sort of allude to, Jared, is the fact that you can get a Lamborghini or Ferrari that can rival that production, but it's going to cost you at least twice as much, maybe even 3 times as much. And I think that's where the
You
Corvette.
can buy American.
Yeah, exactly. Bowling Green, Kentucky, where this car is made, right? So this car is GM just sort of, I don't know how they did it, but they made a supercar for a third of the price. The question is, for a lot of people that buy these cars, they have a lot of money, they want the prestige, they want the exotic car maker. Is it a Lamborghini or Ferrari? Not really. But if you really want the best performance for the dollar, I think you can't go wrong with this car.
And I understand you were recently in the crypto capital of America, my hometown, Miami. I lived there for several decades, grew up there. What is the vibe there? How do you think the ZR1 would fit in Miami?
I think in that color, which was called Roswell Green, right, for the alien turtle. I think that color would really do, right? You tell me, right?
Roswell Green, I love
in
that.
Miami, right? That green would do great, right? But like you said, Miami is a show me place, right? And that's where this prestige thing comes in, where it's like, you know what? I might pay double to get a Ferrari. I think that's sort of like the issue with Miami is that you want to kind of be seen, you want to have I can spend my money better than you can. But for those that really care about performance and they care about this car is the real deal, the Corvette would do well in a place like Detroit. It depends where you're at. But in Miami, you got to have that green. At least get the green.
Yeah. Okay. Anything else that's on your radar? It doesn't have to be about the ZR1 or EVs. What's new in Carland?
Carland, I think we're still kind of stuck with this pricing thing where I just saw, the average new car price is still over $50,000. I saw a stat today, I think it was from Edmunds, that the average new car payment is $722.
Wow.
Which affordability is going to be a huge issue. And I think we're seeing that with prices. We're seeing that with jobs sort of weakening in this
we just
country.
had the second worst jobs headline number since the pandemic.
So how are people going to buy new cars, let alone cars that cost on average $722 a month? I think that's going to be a huge problem for the mainline automakers is how they sell new cars. Can they pump out enough affordable vehicles that can go below that $500 monthly payment, which I think is sort of what is the threshold for an affordable car, which is still pretty pricey. Over $700 is crazy to me.
Yeah, I'm so happy that I live in New York and I don't have to have a car payment. Praz, thank you so much for stopping by here on a Friday. And stick around, much more Asking for a Trend still to come. Gap shares falling after missing Q4 expectations. Yahoo Finance executive editor Brian Sazi, he spoke to the Gap Inc. CEO Richard Dixon about these results. Let's take a listen.
9 straight quarters of positive sales at the Gap. I put this post out last night on my X account calling this turnaround at Gap stunning. And now I'm hearing you saying you were going back into growth mode with this division. What does growth mode look like at the Gap brand in particular this year?
All right, Brian, thank you. I'm all in on good news. We did deliver a successful fourth quarter, and that's marking another year of really meaningful progress for Gap Inc., which you've been watching the past couple of years. We achieved our second consecutive year of top-line growth, and 8th consecutive quarter of positive comparable sales. We noted, the comps were up 3% in the quarter, meeting our expectations. Old Navy up 3% as well, largest specialty apparel brand in the U.S. Gap up 7%. That's on top of 7% last year also. Banana Republic, 3rd quarter in a row of positive comps, up 4%. So we're winning across all income cohorts. Also important to note, this was one of our highest gross margin years in the last 25 years. We've improved our balance sheet. We're ending with $3 billion in cash. So this is a progress point for us and a pivotal point in our transformation. I do want to double click on the brand Gap. As you said, it is so exciting to see our namesake brand building on success literally quarter after quarter. The 4th quarter marked the brand's 9th consecutive quarter of positive comps. We've been consistently gaining market share. It's through great product assortments, great marketing, and in-store execution. Team has done a brilliant job, literally driving a multi-generational appeal. And ultimately, we're watching all income cohorts appeal to Gap. More high-income consumers are choosing Gap. Categories, fleece, logo, denim, sleepwear, all doing incredibly well. So we can be, very confident in saying that Gap is firmly back in the cultural conversation. It's a true pop culture brand. Product resonance from red carpets to surprising collaborations, and I can guarantee you a lot more exciting moments to come in 26.
If I was sitting here 15 years ago saying I'm going to talk to the CEO of Gap and they're going to be putting more CapEx behind the Gap brand, I'd be like, well, I don't know about all that. But Richard, you are. This year you teased a new store format for Gap. What does that store look like? Because you also teased a bigger push into accessories finally, and a bigger push into beauty. Like, these are your 3 big growth levers for Gap this year. Like, how does that impact the business, and when do all these things hit?
Yeah, well, first let's talk about beauty, because I think, in the context of what we shared in relation to our strategies of extending our brands, first we're going to drive continuous improvement on our core apparel business. So the recognition that we've got a good flywheel going, better product, better storytelling, better in-store execution, that will continue. And then we're extending our brand into accelerators such as beauty, accessories, and we mentioned fashion-tainment. Beauty is one of the fastest growing, most resilient retail categories in the US, and our customer insights are reinforcing strong demand for the category. Now, when you look at other fashion and apparel retailers that have a beauty business, the category represents anywhere from 5% at a low to 20% of their sales. And when you think about those percentages against our base business, it really does highlight the meaningful potential that this category can represent within our business over time. It's also, I think, important to note, we do have a beauty business. It's just underdeveloped. And based on our feedback from consumers, we know the potential of this category is enormous. So we announced plans for our expansion in 2025. We've got a phased introduction of this, starting with Old Navy. You're going to see Gap relaunching its fragrance later this year. And we'll continue to build this category out, along with accessories, fashion-tainment, and as you mentioned, new store rollouts. We renovated and have some remodels that we've been testing over the last couple of years. Flatiron in New York City, Chestnut here in our hometown in San Francisco, and some other areas. These stores are outperforming our existing fleet, giving us the confidence so we can start to really accelerate these new store remodels, reformats, and even new doors in the coming future. So a great position for us to be in, and one that we believe is a pivotal point in our transformation.
Richard, you mentioned on the call last night $150 million in cost savings this year. And look, I said at the top of the show that I think AI is really starting to impact many jobs in this country. We, of course, saw that news from Block. Like, out of these savings, how much does it reflect the company leaning in on AI and rethinking its workflows?
Our capital to go after the accelerants and ultimately reinvest in the core of our business. And technology is a key part of that. I mean, we do pride ourselves on being a human-centered, digitally enabled company. And our AI investment approach is very disciplined. With this foundation in place in the context of our Office of AI, we're really focused on 3 strategic layers. The first is reinvent. AI is helping us create new tools, new ways of working. It's changing literally how we design products. The second one is optimization, enhancing existing systems and experiences with real-time insights. This is impacting how we plan our business, even how we price our product. And the third is enable, empowering every member of our team with AI tools and the training to move faster and ultimately think bigger. So we're focused on areas where we believe AI can meaningfully reduce customer friction, increase predictability across product to market, and ultimately unlock enterprise productivity. There's lots more that we could share in the context of what we're doing. Our headquarters are in the Bay Area, so we continue to work with our neighbors, modernizing our organization, partnerships with Google Cloud, many exciting opportunities to drive innovation across our business, and obviously we'll keep you updated on all of that as things move forward.
Richard, of course, you and I, we can't control the stock market. We can't control what's happening over there in the Middle East, but what you can control as the CEO of Gap is what you sell your products for. Now, how concerned are you this spring is going to be really a spring selling season for Gap and retail of discounts, because consumers are more pressured, their gas prices are higher, their bills in other areas are higher because of what's happening in the Middle East? Like, what levers are you prepared to fill?
Well, look, we are always living in a competitive environment, and it's our job to offer the best product, best price, best quality to break through, if you will, from the competition and grow our business, and we have been. Obviously, I mentioned 2 years of consecutive comps. It's also been market share growth, which really indicates that we are winning in the competitive landscape. Now, as you know, it is a promotional and highly competitive landscape, and promotion level is very much dependent on the competitive environment that we're operating in. It's our job to deliver on our customers' needs and wants. Our top priority is to execute the product and marketing to drive interest and demand. In the fourth quarter, we were actually less promotional year over year, and we drove greater impact and excitement. It's a strong proof point of the strength of our brands and our marketing effectiveness. So as we move into 2026, of course, we'll continue to be strategic about our use of promotions. We are obviously aiming to compete, and any promotional strategy that we currently have is already built into the gross margin outlook that we provided yesterday.
And that is a wrap on today's Asking for a Trend. Thank you for watching.